All right, welcome to This Explainer. Today we're diving into a massive 60-year statistical analysis to answer a huge question. Is stock market charting actually rigorous science, or is it basically just reading tea leaves? I mean, billions of dollars are traded based on these exact shapes literally every single day. So we're going to look at a really fascinating study out of Georgia Gwinnett College that puts one of the most popular financial tools out there squarely under the microscope. So let's get right into the core mystery here. Can Japanese candlesticks, a tool invented way back in the 18th century to forecast rice prices, actually work on modern Wall Street? You know, they were virtually unknown in the West until about 1990, but today, you honestly can't open a financial website without seeing them. But do they actually have real predictive power? Here's our agenda to figure that out. 1. Predicting the stock market. 2. Anatomy of a candlestick. 3. Shooting stars and hammers. 4. The S&P 500 stress test. And finally, 5, the surprising verdict. Okay, section 1, predicting the stock market, the EMH versus technical analysis. So, on one side of the ring, we've got traditional academia, the efficient market hypothesis, or EMH. This is essentially the ultimate party pooper for day traders. It argues that all relevant information is already baked right into the price of a security. So according to the EMH, you simply cannot consistently beat the market using public info like past prices. It's just not going to happen. But on the flip side, technical analysis argues the exact opposite. They say studying historical charts is really all you need to forecast future price trends. Technicians rely on 3 main assumptions. First, market action discounts everything. Second, prices move in trends. And third, and this is absolutely crucial for our explainer today, history repeats itself. Basically, if a pattern predicted a drop yesterday, it should predict a drop tomorrow. Moving on to section 2, anatomy of a candlestick, visualizing the trading day. To really understand the data, we've got to understand the visual. A single candle instantly records a day's battle using just 4 specific data points: the opening price, the absolute highest price reached, the lowest price reached, and the closing price. With just those 4 points, you get an instant visual story on the chart. The really important thing here is distinguishing the thick main box, the body, from those thin vertical lines, which we call the shadows. The body just tells you the difference between the open and the close. Straightforward. But those thin lines above and below, the shadows, those show you the chaotic extremes the market swung to during that specific day before it finally settled down. Let's look at section 3, shooting stars and hammers, the suspects on trial. Out of dozens of possible patterns out there, we're putting 2 really famous opposites on trial today. First is the shooting star, labeled A, with its tiny body at the bottom and this long upper shadow. And second is the hammer, labeled B, featuring a small body at the top and a really long lower shadow. What's wild is how these 2 visual opposites are supposed to predict major trend reversals. Take the shooting star. It implies the market rallied hard during the day, creating that long upper shadow, but the bulls just couldn't hold it, and prices collapsed back down near the open. That's believed to be a bearish sign, forecasting a market top. The hammer is the exact inverse. The market sold off heavily, creating a deep lower shadow, but then buyers stepped in and rallied the price back up to close near the top. This one is seen as a bullish sign, forecasting a market bottom. All right, section 4, the S&P 500 stress test, 60 years of data. So, to get the hard numbers, researchers wrote a C# computer program to impartially scan over 6 decades of historical data, from 1950 all the way to 2017. They specifically chose the S&P 500 index to ensure a completely fair test, mainly because it's so highly liquid that no single participant has enough capital to artificially manipulate it for long periods. They programmed strict parameters for what actually constitutes a small body and a long shadow, and then tracked exactly what happened 5, 7, and 10 days after the pattern showed up. To objectively measure success, they looked at 2 different criteria. And listen, this distinction is where our entire investigation pivots. First, they tested the close criterion. Basically, did the closing price of the shooting star serve as the absolute top for the next 5 to 10 days? Then, they tested the high or low criterion. Did the absolute highest tip of the shooting star shadow serve as the top, or did the lowest tip of the hammer shadow serve as the bottom? This brings us to section 5, the surprising verdict, the plot twist. Okay, so out of more than 16,000 trading days analyzed, things initially looked really bleak for technical analysis. Through rigorous statistical testing, the researchers found that using the closing prices to predict the top or bottom failed spectacularly. I mean, these famous candlestick patterns were basically no better than flipping a coin. The success rate for the candles was comparable to, or sometimes even lower than, totally random regular trading days.
But look at this twist. On the left side of the data, under the word close, those gray boxes are totally in line with random chance. But when researchers switched to the high criterion over on the right side, the shooting star success rate violently jumped up. The tail of the shooting star data is actually higher than the data for all regular days. It significantly outperformed random chance. No way, right? And the exact same phenomenon happened with the hammer pattern. When they tested the hammer using the close criterion on the left, total bust, totally ineffective. But when they tested it against the absolute lowest prices of the day, the low criterion on the right, the predictive reliability clearly outperformed a randomly selected candle. The stats actually confirm that bottoms were significantly dependent on the hammer appearing, but only provided you measured from the very bottom of its shadow.
So the final verdict is incredibly nuanced, and it's perfectly summarized by the researchers themselves. The charting patterns actually do work, but only if you're looking at the absolute extremes of the data. If you try to build a strategy assuming the market won't cross the closing price of these patterns, well, you're statistically out of luck. But if you use the extreme tip of the shadow as your boundary, this 300-year-old Japanese technique actually holds a surprising amount of scientific weight. So I'll leave you with this thought to consider. Perhaps true market sentiment isn't actually found in where the day cleanly ends at the closing bell. Maybe it's found in the chaotic, emotional extremes we reach along the way. Thanks for joining me for this explainer. Keep questioning the data, and I'll catch you next time.